on to today's fundamentals. Hello, Peter.
Hello.
So what's up in the FX market?
Well, we have the US dollar, which seems to be recovering some of the lost ground over the past 10 days. I think it's the main characteristic move of the FX market. And it could be related also to the Fed's interest rate decision tomorrow, as attention is increasingly shifting towards that way. Now, the bank is expected to hike rates by 25 basis points, yet the market at the same time expects the bank to remain on hold after that, up until the end of the year, and most probably cut rates in March. Nevertheless, that remains to be seen, and I think we have more analysis on that tomorrow.
And how about the US stock markets?
US stock markets had a rather mixed picture. It was characteristic that we had Dow Jones, S&P 500 being on the rise yesterday, but Nasdaq was not. And it's interesting in the sense that we have market attention regarding US stock markets shifting towards the tech sector, given that we have earnings reports of high-profile companies which are due out this week. We make a start today with Microsoft and Alphabet, Google, in the aftermarket hours. So we expect any effect on the share's price to be observed practically in tomorrow's opening. However, that's going to be followed tomorrow by another two interesting releases. That would be eBay and Meta. And on Thursday, we get Amazon, and I would be also noting Intel. So, like last week, we had market attention being shifted towards the banking sector. In this week, I expect the market attention to shift towards the tech sector. More or less, I would expect tech companies to be able to surpass expectations. However, I have to note here that the hurdle and the market expectations have already been lowered considerably. So it's a little bit of a question mark here. And the strained financial environment in the US, especially given the cumulative tightening of the Fed, may have an adverse effect on these companies.
And back in the FX market, what's going on with the euro?
The euro seems to be in trouble. We have, especially after yesterday's release of the preliminary PMI figures for July, we saw readings indicating an even deeper contraction of economic activity, and that would be, in the big picture, practically across sectors and across the Eurozone. However, I would be highlighting the spearhead of Germany's manufacturing sector, which showed a reading of 38.8. I think that's a reading not seen since May 2020, practically since the pandemic. And it's characteristic of the overall contraction of economic activity in the Eurozone. Mind you that Germany's auto industry faces a number of problems. Among them, we have more intense competition regarding electric vehicles. By the way, mind you that the German government has set a target of 15 million electric cars in the roads of Germany by the end of the year. That seems to be impossible for the time being. And we have also a shortage of specialized staff, which creates further delays in the production. Other than that, I would be also highlighting the high energy costs faced by the manufacturing sector in Germany, which tends to be another hurdle to be overcome, practically compressing the profit margins. I would be highlighting, in addition to the existing problems, also ECB's hawkish monetary stance. The bank has hiked rates, has raised the refinancing rate by 400 basis points in the past 8 months. There was a considerable tightening of the financial environment, and it's expected to hike again rates on Thursday and another time in September. So overall, given that the rates are to remain high for a longer period, we expect that to weigh on economic activity, and that could darken Eurozone's economic outlook further.
And what else is in today's calendar?
Well, we already had Germany's IFO indicators. I would be noting from the UK the CBI indicators. A possible drop of the industrial orders indicator could be bad news for the manufacturing sector. I would also be noting, though, from the US, practically the consumer confidence indicator. I think it's the main release of the American session. And should it drop, that could cause the US dollar to slip somewhat or at least clip its gains. Other than that, oil traders may be more interested in the release of the AP weekly crude oil inventories figure. Should there be another substantial drawdown, that would imply practically that the US oil market remains rather tight and could provide some slight support for oil prices. And during tomorrow's Asian session, we're getting from Australia the CPI rates that for Q2. A possible slowdown as expected could blunten practically any hawkishness of RBA and weaken the AUSSI.
And how about the rest of the week?
For the rest of the week, I would be highlighting 3 interest rate decisions and 2 financial releases. The first would be the Fed's interest rate decision tomorrow on Wednesday. The bank, as we have mentioned, is expected to hike rates, but at the same time is expected to remain on hold after that. There were some comments, though, of Fed policymakers in the past month, which tended to indicate towards the possibility of another rate hike after the July meeting. So should the bank remain rather hawkish, we may see the US dollar getting some asymmetric support here. Mind you that also Fed Chairman Powell's press conference is going to be closely watched. And I expect the Fed's interest rate decision to have ripple effects beyond the FX market and possibly affecting also US stock markets. Should the bank be more hawkish than expected, that could weigh on US stock markets, while at the same time could also weigh on gold's price as well. The second interest rate decision would be ECB's. That's on Thursday in the late European session. Once again, the bank is expected to hike rates by 25 basis points. The market marginally, just barely so, is expecting the bank to hike rates again in September. And should the bank more or less sound a little bit more hawkish, that could provide some support for the euro. Last but not least, during Friday's Asian session, I would be noting BOJ's interest rate decision from Japan. The bank is expected to remain on hold at minus 0.10%. That's not the question. The big question is whether the bank will be tweaking its yield curve control policy or not. Should the bank actually widen its tolerance level regarding the yields of Japanese government bonds, I think that could be perceived as the start of a tightening cycle and could provide some support for JPY. On the flip side, should the bank actually fail to provide such indications, that would more or less solidify its dovish view and could weigh on JPY, as that would possibly indicate that the monetary policy outlook differentials between the Central Bank of Japan and other central banks are widening and could weigh on JPY. As for financial releases, I would be noting practically, it's not exactly 2, but they are on 2 instances. We have in Thursday's American session the release of the preliminary GDP rate of the US. It's expected to slow down from 2% to 1.7 quote-unquote on an annualized basis. It's understandable that we may see a slowdown of the expansion of the economy of the US, given also the cumulative tightening of the Fed. Should the rate slow down more than expected, that could cause the US dollar to weaken somewhat. Other than that, I would be highlighting in Friday's European session a busy session for Euro traders. We make a start with France's preliminary GDP rate for Q2. Mind you that attention has already started to shift from inflation towards growth, and I think that would be highlighting the release somewhat. But we also get the preliminary HICP rates of France and Germany, which are going to be interesting reads. Inflation is expected to slow down even further. Main focus is on Germany, which instead of slowing down in the last release, it actually accelerated. And that was a concern, implying that the Germans would be hardening their stance in the ECB. I think it's going to be an interesting week, especially for those two currencies.
Great. Thank you, Peter, for your time, and everyone for watching. Join us after a short break for technical analysis with Peter Yosif.
So, welcome to the technical analysis part of the presentation for today. In front of your screens, you have the US dollar index. It's the 4-hour chart. My name is Peter Yosif, senior market analyst at IronFX, and we'll be together for the next half an hour or so. So, practically, what we see is the US dollar rising, and I think that would be more obvious in the daily chart. You can see how it had 1, 2, 3, 4, 5 consecutive days of wins, and it's hesitating somewhat during today's European session. I would expect that the American session may be telling a different story here. For the time being, let's also add some labels in order to actually be able to have a better look. Starting with the R3 being at 103.75, sorry, in red. And then comes the R2 at 102.60. Then we have the R1 at 101.60. And the S1 green. The S2 99.80. And the S3 at 98.80. That's correct. Yep. Let's verify the results. And the S2 being the 99.8, correct? And the S1 being the 101.8, so we have to make a small correction here. Sorry. Hundred and 1.6, 102.6. Let's verify this. Yep. So that's it. So we tend to maintain a bullish outlook as long as the upward trend line remains practically intact. And in that case, we may see the US dollar index starting to aim for the 101.60. I see that you guys note that there is no actual label here for the chart. Correct. It's the USD index in black. Okay. On the other hand, should the pair stabilize, given that it has failed to create the higher peaks, you can see that more clearly. Let's drill into the 1 hour chart. You can see that we have one peak, second peak, and a third peak, all at around the same level, which tends to imply that some stabilization is in play here. I wouldn't say it's a triple top, no, but definitely there is some kind of stabilization here. On the other hand, there is also bouncing on the upward trend line. So should the pair stabilize, I would expect it to correct lower, break the upward trend line, exactly highlighting an interruption of the upward movement, but possibly remain above the S1 100.80. On the other hand, back to the 4 hour chart, should the bears take over, I would expect the index to drop, break the upward trend line once again, but this time also break the S1 100.8 and start aiming actively for the 99.8, 100 pips lower. Okay, let's move now to Euro USD. I think the downward movement here is clear as the pair approaches the 1.1010 support line. Let's add some labels. Let's have also look at the S2 at 1.0925. And the S3. 1.0835. Adding now the resistance line labels, starting with the R1 at 1.01095. Let's verify this. Sorry, that would be 1.1090. Let's correct it. And adding also the R2 at 1.1185. And the R3. 1.1275. Adding also the label for the trading instrument. That's it. So we tend to maintain a bias for the downward movement to be maintained, the bearish outlooks. That's also being enhanced by the RSI indicator, which has been dropping below the reading of 30 once again. Once again, highlighting how strongly bearish the sentiment is, but also at the same time, maybe implying that the pair has reached oversold levels and maybe ripe for a correction higher. Nevertheless, for the time being, I expect the pair to drop, aim if not breach the S1 1.1010, and start aiming for lower grounds, with the next possible target being set by the bears at 1.0925, a prior resistance level, which now has been turned into support line. Now, should the bulls take over for any given reason, despite this being rather improbable, but it's still a possibility and should be covered, then we may see the price action reversing direction, rising, breaking the downward trend line, once again signaling an interruption of the downward movement, but also breaking the R1 1.1090 and start aiming actively for the R2 1.1185. Let's have a look at GBP USD. Starting with the R3. At 1.3140. In red. Let's verify this. Yep. Second resistance line. Give me a sec. Being placed at 1.2995. First resistance line, which is actually right now active. You can see how the price action is testing it at 1.2850. Moving now to support lines, 1.2730 being the S1. And the S2 at 1.2595. And the S3 at 1.2485, if I'm correct. Yep. Yeah. Now we have an interesting element here. On the one hand, there seems to be a shift of the downward trend line to the right, but in my opinion, this is not a shift, it's a break. And despite it being a lower peak than this one's, I still consider this to be a break, and I would expect some stabilization of the pair. It's interesting how the RSI indicator has risen, nearing the reading of 50. It's actually right now at 40, but definitely it has put some distance between the previous 30s. So I would expect the bearish sentiment to slowly fade away. On the other hand, we have to recognize here that the pair, for which we have to add also label, is mainly USD driven. And that's a bit of an issue. Let's not forget that we have UK releases today, the CBI indicators, which could provide some support for the pound should they be somewhat favorable. On the other hand, they may also weaken the pound. For the time being, though, I would expect some stabilization of the pair around or just below the R1 1.2850. Should the bears regain control, that would practically shift the downward trend line to the right, and I would expect the price action to start aiming, if not breaking, the S1 1.2730. On the other hand, should the bulls take over, I would expect a decisive move upwards, breaking the R1 1.2850 and start aiming for the 1.2995. Once again, the fact that the RSI indicator has risen a little bit, the fact that the downward trend line seems to have been broken, both indicate towards a sideways motion. Also note how the Bollinger Bands have started to converge, more or less implying that volatility may be lowering, which could allow sideways motion to be maintained. Let's have a look at USD/JPY. Here I think it's far more clear. We have a stabilization of the pair. However, let's add some labels. Starting with the trading instrument. R1 at 146.55 on red. Let's verify this. Yep. Placing now the R2 at 144.65. The R1 at 143. Current support line being at 141.35. Second support line being placed at 139.10. And the last one, the S3 at 137.25. The price action has broken clearly the upward trend line guiding the pair, so that's a clear indication that the upward movement has been interrupted. Hence, we switch our bullish outlook in favor of the sideways motion, most probably maintaining the pair at around the S1. On the other hand, should the bulls regain control, I wouldn't be surprised to see the price action rising and aiming for the R143. The case for the bulls is being made practically by two elements. The first would be the rise of the 20 moving average, which is the median of the Bollinger Bands. On the other hand, the RSI indicator tends to remain a little bit high. Not much, just a bit. It's right now at around 60. So that's a little bit more bullish. But for the time being, I do not see that being reflected in the price action. Once again, I expect a sideways motion, possibly around the S1 141.35. On the other hand, note though that the pair remains USD driven, and any movement of the US dollar over the American session, especially the American opening today, could have a wider impact on USD JPY. On the flip side, should the bears take over, we may see the price action dropping, breaking this 141.35 and start aiming for the 139.10 support level. There's two. Let's have a look at AUD USD. Starting with placing a label on the trading instrument. Placing also for the resistance lines. Okay, that should be a little bit smaller. And in red. We are 2 at 0.6890. We are 1 first resistance line, now placed at 0.6805. The S1 being placed at 0.6730. So we have the first support line, which was actually heavily tested in the past few days. Pretty valid. The S2 at 0.6655. And the S3 at 0.6595. So for the time being, we see that the price action of AUD USD was able to put some distance between itself and the S1 0.6730. However, that does not change, in my opinion, the overall sideways picture of its movement. On the contrary, I would be highlighting the fact that the RSI indicator was able to rise and actually break at some point even the reading of 50, yet corrected lower, and now is running along the median, the middle of the RSI indicator. That tends to imply rather indecisive market, in my opinion, which may allow exactly the sideways motion to be maintained, possibly between the S1 0.6730 and a little bit higher, the R1 0.6805. Should the bears take over, we may see the pair dropping, breaking. Definitely, I would require a break of the S1 0.6730, which provided considerable support in the past 48 hours. And start aiming for 0.6655. On the flip side, should the bulls take over, we may see the price action rising and actually aiming for the 0.6805, if not even breaching it. There is a catch here, and it would be interesting to note. You can see that there was a resistance line far lower, so I would be adjusting my support line, so my resistance line right here. I know I'm narrowing it substantially, but I would be also narrowing this and this. So we have new resistance lines here. And that would be the making a start with the R1, which is being placed at 0.6780. Okay, lower. Nope, 78. 80 is better. I know they're pretty narrow, but to tell you the truth, I think that's far more indicative of the movements right now than the previous levels. Also, this peak cannot be neglected. That's the 0.6840. And the final peak, which is being placed at 0.6895. I think that would be describing the sideways motion of the pair more clearly. Also, I find that the aiming here, here, and here prove this level to be something. I'm noting it. So practically for a bullish outlook, I would require a higher peak than this one. And the pair has to break above the R1 and start actively aiming for the R2. That would allow us also to draw a nice upward trend line. Let's zoom a little bit out. I think that provides us also with a wider picture of the pair's past movement. Back in. Okay. It should be noted, though, that on a fundamental level, we didn't cover the Aussie enough. I think that the announcements of Chinese measures, of China's state planner for more private investments, may have improved the outlook of the Aussie, given that Australia and China have close economic ties. So that's an issue. And I would be highlighting also that the pair is more or less also focusing on the release of Australia's CPI rates, therefore Q2. Now, the CPI rates of Australia are expected to slow down from 7% to 6.2. It's a considerable slowdown, which may more or less blunten the hawkishness of RBA. And that could be weakening the Aussie somewhat during tomorrow's Asian session, should the slowdown be a little bit wider. On the other hand, or if you prefer, on the same side and on the flip side of the pair, we have the US dollar, which is increasingly focusing on the Fed's interest rate decision, which could be supportive under certain circumstances for the USD. Say, for example, if the Fed remains or maintains its hawkishness. Other than that, we may see the US dollar weakening, and that could allow the Aussie against the US dollar to be on the rise. That should sum it up from all of us here at IronFX. Best wishes for solid trading.
Hello, my name is Christina and welcome to another video. This time we will talk about liquidity and volatility in Forex. Let's start with liquidity. So, what is Forex liquidity? Liquidity in the Forex market refers to the ability of a currency pair to be bought or sold without major changes on its exchange rate, Simply put, when you can easily buy or sell a pair, it is considered highly liquid. In fact, the amount of money that flows in the market as well as the number of traders that want to buy a certain asset determine the level of liquidity. When there is a decrease in liquidity, there are fluctuations in the quotations. During such periods, buy and sell order volumes can change many times. Now, which are considered the most liquid pairs? Euro USD, USD CAD, GBP USD, USD JPY, AUS USD, GBP JPY, Euro JPY, USD CHF, and ZD USD are some of the most liquid pairs. They have the highest available trading volumes. However, as markets open and close across the globe, their liquidity can change throughout trading hours. Did you know that the daily Forex trading volume has reached $6.6 trillion, making the Forex market the most liquid worldwide? You can be confident that in such a market, you will always be able to buy or sell an asset, as there will always be someone available and willing to buy or sell. This is what liquidity is in a nutshell. Stay tuned for part 2, where we will talk about volatility in Forex. Thank you for watching.
All right. Okay. I think we're ready to kick off. All right. Okay. So today's webinar series by IronFX is about fundamental trading strategy. So once again, the information in this webinar is purely for informational and educational purposes. Please do not construe it as investment advice or investment recommendation. And please do all due diligence prior to uh, putting on any trades across any asset class, right? Okay. So the full risk warning and disclaimer is here on this page. Okay, so this webinar is brought you together in partnership with EFG Everest Fortune Group. We're the finalists for Best FX Research from 2019 to through 2021, Best Equity Research in 2020 and 2021. So I'm your host today, Ketan, and let's start things off. Okay, so over here, we have a slide on the data links for where we can get fundamental information about the United States. All right, feel free to take a screenshot of this, but also not to worry, all these other links here can be found on Forex Factory. So basically, you guys just need to know and remember Forex Factory. And once you're on that site and you search for the economic calendar, and I will also teach you how to search for the respective economic news events, and from there we are able to find all the sublinks. Okay, right, so do not worry, you can take a screenshot, feel free, but the main link to look out for is Forex Factory, right? Okay, so let's go and go into Google. All right, okay, so here we have Forex Factory, right? Okay, just a quick note, you guys able to see the page, Forex Factory? Yes. Just maybe a quick show of hands to see that you're able to view that page. Right. Okay, wait, hang on. Yeah. All right, guys. Sorry. Okay, I assume everyone can see my Forex Factory page, right? Okay. So if that's the case, let's continue. Okay, right. Okay, so here we have Forex Factory. Depending on your time zone, it will give you the time. Okay, today is now. Okay, I've not refreshed the page, so let me refresh the page. Hang on. Okay. Yep. Okay. So this is 6:05 p.m. UTC +8. So this is Singapore time. Today's date is 12th of April. Right? Okay. So now let's just start. Okay, we're going to look at US fundamental data. Okay, so Forex Factory is a good website, and with its economic calendar, which is on the homepage, right? So if you come to Forex Factory, I just do a Google search, Forex Factory, right? It will take you to, oops, sorry, hang on. Wait. Yeah, okay, yeah. So if you do that, yeah, you search for Forex Factory, it'll come here, right? And on the homepage, okay, let's just refresh the homepage. Okay, if you click on home, it'll bring you to the main page here, and this is the economic calendar right here. Okay, so what we're going to do is we're going to uh, look through, for example, let's just start quickly uh, through the month of March. Okay, so we had the FOMC meeting, right? The Federal Reserve had its interest rate meeting in the second last week of March, right? So 22nd and 23rd of March was the meeting. So let's start the calendar from 20th of March till the present date. Okay, and let's just filter to look only for US related events. Okay, so we'll cover the the events that will have the most impact, right? And we'll cover all the event types and just US. Right. Okay, so this brings us to our starting date, March 20th. And we have a list of various economic events for the US. Okay, so because we are looking at foreign exchange FX, we'll be looking at what central banks are doing. So the FOMC is a big uh, event led by the Federal Reserve, which is the largest and most influential reserve central bank in the world, right? Okay, so let's quickly look at that. So we have this event here, March 23rd, 6 or 7 this is obviously UTC time. So this, because we're UTC +8, this will show us as Thursday, March 23. Okay. Now, if we look at the we have the federal funds rate. All right. So if you click on this folder here, it tells us the source of the data and the links and a description. Okay, so I think you guys should be pretty familiar with this. And also, if we click on the graph here, it will tell us the history of the interest rates as well. So how the Fed raised interest rates in 2016 all the way till early 2019 before cutting them and bringing them down to zero because of oh, sorry, not zero, but very close to zero because due to COVID. And then after that, in order to combat inflation, they started uh, raising interest rates very aggressively. This is this period has been one of the fastest, or if not the fastest, rate of interest rate hikes, which has caught many people off. Even though the Fed did uh, forewarn markets that they would uh, aggressively raise interest rates to combat inflation. Okay, so now we have this here. Okay, so if we click on the folder, we click on latest release, it takes us to the Federal Open Market Committee website, right? Uh, so that's what FOMC stands for, Federal Open Market Committee. Over here, we are able to find out the calendar meetings for 2023. And as you can see, the next meeting or the third meeting for this year will run from 2nd to 3rd May. So from now till then, we've got about uh let's see, what, 3 weeks. Yes, 3 weeks, about 3 weeks before the next meeting comes up, and all eyes will be on Chairman Jerome Powell. And also we are able to view uh the statements, the history, the historical statements, and press conference. So if I click on PDF, you are able to read the full press statement in detail, as well as view the press conference as well. So there's a YouTube video here, which you can, if you choose to, you can read through it as well to determine exactly what uh, uh, the chair Jerome Powell was saying, because his impact, his words during the FOMC meeting can have a meaningful impact on markets moving forward. Right? If he's sounding very hawkish or dovish during the meeting, it can have a meaningful impact on currencies. Right. So when we say hawkish, it means him and his other committee members are looking to further increase interest rates. And if it's dovish, it means he could be pausing interest rates or uh, cutting them. Okay. So we have the FOMC website here. So one of the things to look at is what central banks are doing and when are the meeting and when are the upcoming meetings. So the Fed is the biggest central bank, and it's important to see how they are raising interest rates. So as you can see here, we have now reached 5% at the after the last meeting in March. Okay. Another thing to look out for would be, right, as we scroll down, there's also other economic data. Something that we would also need to see is GDP numbers, right? So if the US economy is strong, GDP is strong, we can expect the Fed to still continue raising interest rates if they need to do so, right? If the economy is stalling, we have negative growth or negative quarterly growth of GDP, then something is wrong, right, with the economy, and the Fed is very likely to pause or even cut interest rates, right, which would further weaken the dollar, weaken bond yields, and drive the dollar index lower against its major currency pairs. Okay, so if we look at GDP here, so you can see GDP after the COVID lockdowns, GDP rebounded strongly in December 2020. I believe this should be the fourth quarter of 2020 or the third quarter, this result. And then uh, it's been growing pretty steadily. And in the first half of 2022, okay, so this is Q1, Q2, sorry. Okay, although this is saying here June and September, but this is actually the GDP data for Q1 and Q2 of 2020, where we had two periods of shallow negative growth, which constitutes a technical recession, right? And and then followed by a strong rebound in the second half of 2022, where growth bounced back to about, what is it here? Let me see. Okay, 3.2% and 2.6%. So we have strong growth uh, to end 2022. All right, okay. Okay, so now we shall close the graph. And if we click on the folder, right, it'll show us that the source for this piece of information is the Bureau of Economic Analysis. If we click on latest release, it'll also take us here. So you can see the latest GDP data was announced on 31st March. And you can find out more details. Oh, wait, sorry, this is by state. It should be this one here, sorry, on the 30th of March. Okay, so you can give us more details and information regarding the state of the economy. So after looking at what central banks do, we look at GDP numbers as well. The next piece of information to look out for would also be ISM manufacturing numbers, right? PMI numbers for services sector and manufacturing sector, right? Because GDP is announced on a quarterly basis, although you do have updates along the way, they are not as regular. The data is not as regular as other agencies. So if you look at ISM PMI manufacturing, right, we click on it. ISM stands for Institute for Supply Management. click on latest release. It takes us to their website. Okay, so accept cookies. So we have PMI reports, purchasing managers index reports for the manufacturing, services sector, and hospital. Hospital was something relatively new that came up just after COVID, but we will look at more on manufacturing and services. So if you click on view charts for both manufacturing and services, right? Are you okay? It takes us to shows us the overall state of the economy on a monthly basis. This is for the manufacturing economy, manufacturing sector, where we can see manufacturing has actually been contracting since the third or fourth quarter of last year and is still in a contraction zone. So any reading below 50 means that this sector is contracting, and any reading above 50 means this sector is expanding, right? And here you have the sub indices as well: new orders, production, employment, inventories, prices. So one of the reasons for okay, so similarly, this is for services sector. Services are still expanding pretty steadily, although the latest result dropped to 51.2, but is still in expansion territory. So you can see the US economy is being held up by the services sector, right? And also let's open this up. Okay, so you can see there's similarly for both manufacturing and services sector, there are sub indices such as new orders, employment, prices, imports, exports. So what I'm going to zoom in on here is the prices indices, right? Because the main reason central banks are raising interest rates is due to inflation, right? Rising inflation. And in order to combat inflation, the Fed can only do one thing, and that is to raise interest rates, make lending more expensive for corporates, for retail, for households, right? They have a very blunt tool, and that's the one of them primary tools that they can use to try and combat inflation. Okay, so why is prices important here? The prices sub-index for both manufacturing and services, right? So if we scroll further down, right, so you can see throughout from early 2021, the prices index for the manufacturing sector was already at pretty high levels, right? It was almost, this looks at, yeah, almost 90, right? Almost 80 plus onwards. So the prices indices were already elevated throughout 2021, which should have uh, signaled to the Fed that probably was already time to raise interest rates in uh, 2021 instead of waiting all the way till the start of 2022. So the prices indices for the manufacturing was elevated. Similarly, we should see something similar for the services sector as well. So services sector prices were also increasing pretty rapidly and remained constant throughout uh, 2021, 2022 until the middle of 2022, where it has been descending pretty steadily as interest rates were raised. So similarly, for the manufacturing sector as well, the prices indices were also dropping. So what this means to say that is the rising interest rates by central banks, especially the Fed, made borrowing expensive uh, for corporates, for manufacturers, and all other participants. And when things become more expensive, generally demand pulls off. So as demand pulls off, price will start to recalibrate and probably uh, trend lower. So as demand pulls back, price prices for the in the manufacturing sector and services sector started pulling back. So you could see the effect of um, inflation or the effect of rising interest rates on the prices indices of the services and manufacturing sector. So this is important because this also relates to the overall CPI numbers, right? Inflation data. So as prices fall, CPI falls, the the job of high interest rates or the tool of high interest rates is helped to slow down inflation. So if you look at annualized inflation, right? And speaking of inflation, that is the number that is coming out today, right? 8:30 p.m. UTC plus 8 is where the Fed, sorry, not the Fed, the Bureau of Labor Statistics, BLS, will announce their inflation figures for the month of March, right? So just before we jump into inflation, we can also look at sorry, where is it? Non-farm employment change, okay, and the unemployment rate. So another important fundamental factor to look out for the US is the employment reports. So this is the non-farm employment change and unemployment rate. So similarly, if you were to click on latest release, right, it takes you to this page. So basically, Forex Factory is the primary website that you need to remember, because all the other sublinks can be found on their website. So it takes you to, so we clicked on employment non-farm change. So it takes us to this page. Okay, it's always easy to visualize data or information through a chart. So if you scroll right to the bottom, you will see a link for news release charts. Okay, so let's just click on that. Okay, so the first uh, chart that it shows us is the civilian unemployment rate. So as you can see, after spiking as high as 14.7% in April of 2020, as economies reopen, uh, jobs, companies started hiring again. The unemployment rate fell pretty sharply and steadily, and it's been hovering between 3.4 and 3.7% for the past, nearly a year now, right? So despite uh, the tech layoffs that we've been hearing about a lot, unemployment rates are still historically low. And this tells us that the tech sector is just one uh, industry in a wide range of other companies, right? So it may not be uh, the tech layoffs, although they are high in absolute numbers and in relative numbers to the size of the company, it's not representative. It's not representative of the entire American workforce, right? So you can see unemployment rates have been pretty low. So this tells us, together with uh, non-farm payments. Okay, so non-farm would be, yes, here, employment by industry, I believe. So click on employment by industry, click on go. Yep. So this gives us total non-farm figures, right? So if we just take out private, is just a subset of non-farm. So we shall just look at total non-farm. So as you can see, after the huge drop uh, in the workforce, right? The workforce numbers, they have they have surpassed the pre-COVID highs and are making all-time highs here. So basically, what you're seeing for the month of March, there are a total of 155 million Americans currently employed. So by looking at unemployment levels, which is the total non-farm figures, and the unemployment rate, it tells us that the workforce is strong, the labor market is tight, so the Fed can still continue to raise interest rates if they wish to do so, right? Because if unemployment rates are rising drastically, non-farm numbers are dropping, it tells us that more people as a whole are being laid off. And this is a scenario where the Fed may actually start to pause or even start to cut interest rates. So this is another economic data point that is worth monitoring, and to understand the rationale behind the Fed's movement, right? Or the Fed's actions rather. Okay. So next, okay. So before we go into the last one, which is CPI. So we've looked, just to quickly cover or to review, we've looked at the FOMC events where the Federal Reserve raised interest rates. It's important to know how much they're raising interest rates. And it's also important to look at their statements and the press conference to see how hawkish or dovish the committee members are. They would also look at GDP numbers to see the actual overall strength of the US economy. And but because GDP numbers are released on a quarterly basis, right? They do not give us timely information, whereas other agencies or information sources such as the manufacturing and services PMI numbers give us a monthly update. And then we can also look at non-farm employment change and unemployment rate, which finally brings us to another important fundamental indicator, which is CPI or inflation. All right, so if we click on CPI in the folder here and click on latest release, again, it takes us to the BLS page where we have tables and text, and the easiest way to visualize whether inflation is rising or falling is by looking at the charts. So we'll scroll down and look at news release charts. Okay, so if you look at the charts here and you click on 12 months percentage change over the past 20 years, click go. You can see the uh, historical performance of inflation on an annualized basis. So we are looking at all items here. And if you look at all items less food and energy, right, although the color scheme is not so great, we have dark red or brown and we have a lighter shade of red here. So you can see both headline inflation and core inflation have been rising. And after headline inflation peaked June of in June at 9.1%, it's been falling pretty steadily, whereas core inflation, which doesn't include food and energy, has taken a longer time to pull back. So as you can see, the latest readings here are for the month of February, and the next one, which the next data point will be March, and that data is being released today at 8:30 p.m. UTC +8. So if headline inflation on an annualized basis drops to lower than 6%, and for core drops to lower than 5.5%, that means naturally inflation is falling, is continuing to fall, and that bodes well for the Fed because it makes their job easier. So it's very likely that moving forward in May, they may not consider hiking interest rates because if inflation is continuing to fall, then for them to keep interest rates at 5% is probably the next best thing to do. So what this means that markets will anticipate that the dollar will weaken and bond yields will fall. Now, why this is happening? Because when markets are expecting the Federal Reserve to be less hawkish, the dollar will fall and uh, the bond yields will also fall. So if you look at this chart here, when inflation peaked in the middle of June 2022, it's about the same time where the dollar index also peaked and bond yields also peaked. So now with that, we shall look at the charts, okay? All right, so this is a DXY chart. Let's just go to a weekly chart so it's easier to visualize what is actually happening. Okay, so as interest rates were being raised aggressively by all central banks, particularly the Federal Reserve, the dollar index was also rising. It went from 95 to all the way to about 115 in within 6 months. And similarly, let's just do a dual chart so it's easy to. Okay, right. Okay, so this is a dual chart here. So what I'll do is for this, I'll switch everything to weekly. The first chart, I'll put the DXY. Okay, and this chart below, I shall put the US 10-year bond yield. Okay, so this is a nominal United States 10-year government bond yields, which is a good indicator of where of what the market expects in terms of interest rates. Okay, so as you can see, at the start of 2022, the Federal Reserve was raising interest rates aggressively due to rising inflation. Bond yields were rising from about 1.5% all the way till to the middle of to June to about 3.5%. Similarly, The dollar index also rose from 95 all the way to July, June, July, hitting about 110. And after a slight pullback, the Federal Reserve was still raising rates, and bond yields and the dollar index made new highs. So this is important because as inflation is rising, the Fed has only one tool or a couple of tools in their toolbox to combat inflation, and that is to raise. One of them is to raise interest rates, and the other is to reduce the balance sheet. These are the two primary tools that they have, or these are the two main ones that's easier to understand for all of us. So in this period, when you have rising bond yields, rising dollar index, naturally, it means all the major currency pairs, your Aussie, your Euro, your Pound, your Kiwi, your CAD, your Swiss franc, and your yen, they're all going to weaken considerably against the dollar. So this is a period where you would be looking to long the US dollar for most periods, right? Of course, there are pullbacks along the way because this is, mind you, this is a weekly chart. Definitely there'll be retracements along the way, but you can see the general trend was strength in the dollar, right? So when you have strength in the dollar like this, you would be looking to go long at any pullback in the dollar, in the strength of the dollar. And as we know, inflation peaked around June, July, and that's when market expectations also reversed, despite the Federal Reserve raising interest rates and keeping them high. Bond yields actually started to pull back and range between 3.4% and about 4%. In that same period, the dollar index has dropped significantly, right? You would think that with the Fed keeping interest rates at this, which was at this time maybe about 4.5%, and raising it to 4.75, and now finally 5, you would think that the dollar would still remain strong. But no, in fact, actually the dollar has sold off very significantly, or very significantly, while bond yields have more or less stayed within 3.5 and 4%. So what this tells us is markets are expecting the Federal Reserve to eventually pause and cut rates. So basically from this point onwards, in the third quarter or fourth quarter of last year, the dollar, naturally as the dollar index falls, all the other currency pairs have gained against it, right? So despite the Federal Reserve keeping interest rates high, the dollar has actually weakened. So if we just quickly look at, okay, so just keep the top one as the dollar index. I will switch the bottom one to Aussie. So similarly, as you can see with the crosshairs, right? This is a weekly chart. So as the dollar index fell, despite the Federal Reserve raising rates, the Aussie gained, right? Because the Aussies were still, the Australian Central Bank, Reserve Bank of Australia, was still increasing rates. Federal Reserve was still increasing rates, but the dollar was actually selling off. And so it's important to notice these changes in price points. And now you can see that we were in a period of downtrend for the dollar from October all the way till end of January this year, before it pulled back up again, retraced higher, and then finally coming back down again. So similarly, if you were to look at, oh, wait, hang on, let me keep this as DXY, top chart DXY, bottom chart, switch to Euro. So similarly, it tells the same story again. With dollar index falling, the Euro started rising significantly, right? Similarly for pound, same story here. Kiwi, also you see a similar story. And let's just look at the last one, which is the dollar yen, right? Okay, dollar yen is a very interesting example because you have two very divergent central banks. You have the Federal Reserve, which was actively raising interest rates, and not only actively, aggressively raising interest rates from the start of 2022, whereas the BOJ, or Bank of Japan, have been in a perpetually in a negative interest rate environment. So there's a big divergence in monetary policy between the two central banks as of 2022. Fed was increasing rates aggressively, going as high as 5%, whereas the BOJ kept interest rates at negative 0.1%. So you would think that with this monetary policy in place by the respective banks, you would think that dollar yen would continue to shoot higher. But no, actually, in fact, the dollar yen peaked at the same time as dollar index, and it's basically a mirror image of the dollar index, right? So this is because the yield differential between the US and Japan started to fall. So now I'll show you how we can use TradingView to help us chart the yield differential. Okay, so the yield differentials between countries, and we will actually help us determine the general trend in the currency pair, and also potential turning points, and also identify long-term trends. So once you know where the turning points, where the long-term trends, you're able to zoom in on daily charts, for 4 hourly charts or hourly charts, and uh, use your appropriate or your preferred trading strategy and style. Okay, so what we're going to do is on the top chart, we'll change it to the US 10-year yield. So just type US 10Y, right? So this is the United States 10-year government bond yields. Okay, so that's the top chart. Bottom chart, we're going to change it to Japan. So that's JP, I believe 10Y. Yes, okay, so JP 10Y. So that's the Japan 10-year government bond yields. Okay, so right now you can see with respect to bond yields, the dollar for the US dollar from the start of 2022, it was about 1.6, 1.7, was rising steadily throughout the year, peaking at about 1.43%. So this is for the US 10-year. And similarly, for the Japanese yield, 10-year yield, it was relatively stable at about 0.2 to about 0.25%, right? And it was only here in December when Japanese bond yields really shot up. Okay, this was due to some central bank intervention. I forgot what it was, by BOJ. Yes, okay, I remember now, because the dollar yen had moved far too high, and because of certain requirements by the Bank of Japan, they had to strengthen the value of the yen. So when they strengthened the value of the yen, there was a big intervention by the Bank of Japan, and this intervention caused Japanese bond yields to spike. So when we had this spike in Japanese bond yields, that's when the yen also strengthened pretty considerably. Okay, so now what I will do is for the bottom chart, I will take the US 10-year bond yield minus the Japanese 10-year bond yield. So the good thing about TradingView is not only can you view the individual charts for bonds, for currencies, especially for bonds, you're able to do the yield differential as well. So just as simple as typing US 10Y minus JP 10Y will give us the yield differential between the United States and Japanese government bonds. So this bottom chart here is showing us the yield differential. And just to put things, and what we'll do, we'll change the top chart. Sorry, we'll change the top chart to dollar yen. Right. So as you can see, they are actually practically a mirror image of each other. So in the sense that if you wanted to know the direction of any currency pair, it will be good to look at the yield differential as well for that particular pair. So for dollar yen, you look at, of course, the US and Japanese 10-year bond yields. For Euro USD, you would do it similarly for European yields, or maybe the German and French 10-year yields versus the US 10. Aussie, same thing. You do Australian 10-year bond yields minus US 10-year bond yields. So by actually tracking the yield differentials together with inflation, right? You see where inflation is heading. Okay, you can see inflation has peaked. Right now I'm on the chart, on BLS chart, where inflation has peaked and dropping. So as inflation is falling, this sets into gear, sets into motion that markets are expecting the Federal Reserve to be less hawkish. Although the Fed will still raise rates, but the hawkishness or the less hawkishness is actually displayed in the movement of bond yields. So that's why it is important to track bond yields, bond yield differentials together with inflation data, employment data, ISM reports as well as GDP, right? So once you have this few fundamental data points, right, it actually helps you paint the overarching picture of what currencies are doing, what bond yields are doing, and what central banks are doing. And basically, it gives us a relatively good idea of the state of the economy for each respective country. So as you can see, okay, so bottom chart here is the yield differential. So from the start of 2022, the yield differential between the United States and Japan was rising aggressively. Of course, there'll be pullbacks along the way, consolidation, range-bound period as well between here, May and August as well, right? But the dollar yen continued pushing all the way till 150, right? Look at it broke 150. Now, because of this price, this movement in price, the BOJ had to intervene. There was a big intervention action by them, which led to Japanese bond yields to spike, despite interest rates being kept at negative 0.1%. So the BOJ didn't alter their interest rates, but they actually intervened in the open market, right, by buying Japanese yen. And when they bought Japanese yen, the yields of Japanese bonds increase. So as this happened, as Japanese bonds yield on the Japanese bond increases and the yield on the dollar stays steady or starts to drop, you will see the yield differential start to fall. So if you are observing the yield differential and paying attention to what the BOJ did with regards to their intervention policy and looking at this DXY and subsequently putting everything together, you will get a complete picture or an overarching picture of why the dollar weakened, why the US 10-year yield dropped, why the Japanese 10-year yield increased, and then subsequently you would see the fall. You would understand the fall in the yield differential. You would understand the sharp pullback in dollar yen as well. So during this period, didn't matter whether Federal Reserve kept raising interest rates or whether Fed's interest rates were at 4.755% and Japanese interest rates were at negative 0.1%. If you just look at interest rates differential, it's still in favor of the United States, but that's not reflected in the price of, or not the price, but that's not reflected in the yield on the bonds. It is not reflected in the strength of the dollar, and it's not reflected in the currency pair itself. So that is why it is important to look at about 4 or 5 fundamental indicators, and this will actually help you to paint the larger picture, right? Because we are looking at weekly charts here. It helps you to paint the larger picture, help you determine turning points in currencies by looking at central banks' action, looking at bond yield differentials, looking at inflation, and plus other information, right? You don't need to look at everything because there's simply too much, right? It's as a individual trader or retail trader, right? There's so much info out there. So what do you look at, right? What do you focus on? So I would say look at what the big central banks are doing. Look at where their interest rates are. Look at where inflation is. Look at where GDP and unemployment figures are. right? This all this data comes out on a monthly basis. So it's not like something. It's not that something we need to track regularly. But then pay attention to the bond yield differentials, right? Because they will signal potential turning points in the currency pair. So that is why I like to use the dollar yen in this example for to illustrate the importance of bond yield differentials, the importance of intervention by central banks, despite the respective interest rates still being very divergent, and to understand why certain moves in FX occurs, right? So once bond yields, the bond yield differential peaked and started heading lower in favor of the Japanese yen, the dollar yen also fell significantly, right? And then it fell, yeah, from 150 to as low as 127. And then as the differential picked up again in favor of the United States, this was another turning point here, right, on a weekly chart. It didn't go lower. It actually formed a base here, and the yield differential started driving higher. So this would have been a clue to indicate that, okay, there's a potential change in direction, and we could expect the dollar yen to uh, retrace some of the losses that it has made. And likewise, again, as inflation expectations also continue to drop, with inflation uh, continuing to print lower, headline inflation and core inflation continuing to print lower, bond yields in US also started falling, and likewise, this is reflected in the yield differential, and hence the dollar yen fell, right? Okay, so I think these are some of what I've covered is basically where to look for fundamental data, which are the key US fundamental data to look out for. And similarly, you could do that for other currency pairs, but that might be, frankly, that's probably a bit too much work, right? Just looking at the US alone takes up quite a fair bit of time for an individual person. So just maybe perhaps I would say concentrate on the US, right? Macro data. So look at GDP numbers, look at ISM numbers, and especially look at prices, because they will tell us where prices for the services and manufacturing sectors are heading. And this relates back to overall inflation. Look at employment numbers, right? Look at how strong the labor market is in terms of total non-farm, and in terms of how low the unemployment rate is. And also look at inflation, whether inflation is trending lower. Is it staying constant, consolidating, or is it starting to pick up again? And ultimately look at bond yields, right? The bond yield differential, right? So, are there any questions, or would you like me to revisit any particular topic or any uh, particular part of this webinar? Right. Okay. Otherwise, I can move on to something else, right? Something else that's coming up big today. So we have, as we've mentioned, we have the okay, let's just zoom in to yes, so of course. So today, 12th of April, 8:30 p.m. UTC +8, we have US inflation data being released. So this is going to drive a lot of the moves in FX and equities and gold later this evening. Well, in Singapore time or in Asia time would be evening, right? So in about 1 hour 40 minutes, right? Doesn't matter where you are, in 1 hour 40 minutes is where we will see a lot of big moves in currency pairs, in gold, and also in um, equities, right? So just as a quick, okay, so since we're talking about gold and inflation, okay, let me switch this to DXY. Okay, again, we are looking at weekly charts. So the top chart is showing us DXY, the dollar index. Bottom chart is showing us now gold. Okay, so let me get rid of volume. Okay, right. So since we are talking about inflation, uh, I think, and we have a big data point coming out this evening, right, on a very short time. I think it's good to cover this as well. So if you, what we're looking at now is the weekly chart. On the top, you have the dollar index. Bottom, you have gold. Okay, so similarly as 2022 began, uh, central banks started, the Federal Reserve started raising rates aggressively. Dollar index shot up, bond yields increased, and also uh, the geopolitical event occurred. Like, right, we had the invasion of Ukraine by Russia, so that created a big demand for gold as uh, as a safe haven asset. So that drove up the price of gold in the first quarter of 2022. But what happens during this period also is, it is important to note why. It's also something to take note. Why did um, gold fall after a major geopolitical event? You would think that investors, central banks would continue to buy gold and drive it higher. But actually, because we know that the strength of the dollar is inversely correlated to gold. So as the dollar increased, right, despite there being a major political event, geopolitical event, the strength of the dollar actually caused, is not the only reason, but it's one of the reason that caused this the price of gold to pull back very significantly. So this is also to do with combination of dollar strength and combination of what we call real yields. Okay, real yields are 10-year bond yields adjusted for inflation. Okay, so what that what that what has happened is, in this period when the gold peaked 2050, 2060, went down as low as 1600. During this period, real yields were actually rising. So when real yields rise, uh, together with the strength of the dollar, this negatively impacts the price of gold. But then the dollar index peaked in October, right? At the same time, gold bottomed. And as the dollar pulled back significantly, and as interest rates, as inflation started to pull back as well, real yields turned more negative, right? I don't have a chart for real yields here, but just try and visualize it. So as real yields became more negative, together with falling dollar, falling inflation, gold became a more attractive hedge against inflation. So what I'm trying to say is, basically, in this period, as dollar index strengthened, bond yields strengthened, gold is generally not a good hedge against inflation. Hence, that's why we saw the sell-off in gold. But after that, the macro picture changed, whereby the dollar index started falling aggressively. Inflation also started falling a little bit. Bond yields started falling. And in this environment, bond becomes a better hedge. Gold becomes a better hedge against inflation. Hence, we see the bid up in gold here from about 16,000, 1600 all the way to almost breaching 2000 here in January. Then before pulling back again, because as the dollar rose, it negatively impacted the price of gold. And also we had the banking scare here, right, in March. So in early March, we had the fallout from Silicon Valley Bank, Signature Bank in the US. Plus, we also had major issues in Switzerland, coming out of Switzerland as well, with UBS eventually having to take over Credit Suisse. So we've also had a banking crisis here, which sparked a drive uh, for gold as a safe haven asset. So as we see dollar index continue to fall, bond yields continue to fall, we may see gold stay elevated around this level. So which brings us to this um, uh, CPI event coming up. So if CPI, so there's several factors to look at CPI. You've got headline CPI, which contains all the components, and you've got core CPI, which doesn't include food and energy. So they'll be looking at uh, the monthly growth of headline and core CPI. They'll also be looking at annualized growth or the year-over-year growth of headline and core CPI. So if these data points, there are four major data points to look at. So if as a whole they all uh, print softer than their estimates, that means they come in lower than all their estimates on a monthly basis, on an annualized basis, and also compared to the previous month, it is very likely that bond yields will drop, the dollar index will drop, and this would potentially create another tailwind for gold. Conversely, if inflation comes in hotter than expected across all uh, four metrics, then it's very likely that bond yields will rise. Dollar index may rise as well, but if bond yields rise aggressively, this would potentially cap any further gains on gold and may drive it lower, right? Okay, so not only have we covered fundamental strategies for forex, we've also looked at a bit of gold because it all interrelates with each other, right? You look at forex currency pairs, you look at bond yields, you look at inflation, you look at dollar index, the strength of the dollar, the weakness of the dollar. You look at bond yield differentials, use the 10-year bond yields and the differentials between the countries to see where um, price is headed, where the major turning points, where the major inflection points, and look out for central bank announcements, what they are doing. And yeah, this would help you picture the big, help you piece everything together to form a large picture. And then once you have it, once you know what the overarching uh, theme is or the environment is, you are able to scale down into daily charts, 4 hourly charts, and hourly charts. So what I've presented here is mostly through weekly charts. So at least we are able to understand the trends, the longer term trends, and also potential turning points, right? Okay, so um, I've come to the end of today's webinar. I hope this has been a good session for everyone. And if there are any questions, feel free feel free to fire away in the chat. And yeah, I'll stick around for I guess a minute or two. And if you have any questions, please let me know whether it's something about CPI today or if it's something about what we've discussed recently. I mean, discuss in this session, or would you like to clarify any other points or any other topics? Wait. Wait, so sorry. Okay, the Harvard. Okay, there's a question I completely missed this. Okay, sorry. Okay. On the day of this release of manufacturing PMI data, does the dollar move the same way? No. Okay, wait, I'll type the answer. Okay, so basically I'll type the answer to Howard and also explain it live as well. Okay, his question is on the day of the release of manufacturing PMI, does the dollar move the same way the NFP data moves the data? Okay, so generally speaking, PMI numbers are important, but they don't have that much of a significant move in currency markets. I mean, it will drive sort of the longer term movement, but on the day of release, it's not as impactful as NFP. NFP data releases tend to have more, or not tend, they create more volatile instances rather than PMI releases, right? So I think that's yeah, different. That's something to understand as well. So different news events have greater significance and introduce higher volatility than others. Okay, so just type the answer as okay. I'll just answer it. I've already answered it. Yep. Okay, then just- right. Okay then. All right. Okay. Yeah, okay. So I've come to the end of the webinar. So yes, so I hope you guys have found this useful. And remember, it's about trying to understand the big picture so that we can scale down and zoom down into your particular your favorite time frame, and then you are able to uh identify trading opportunities, be it on the short or long side, and then try to successfully create high probability trades and trade outcomes for yourself. All right. Okay. Thank you, everyone, and yeah, have a good trading week. All right. Take care, guys, and ladies and gents. All right. Bye.